Good morning, everyone. I'm Vince Lancy. It's Friday. We're going to discuss today in the market rundown. Inflation is getting entrenched. A piece from a couple days ago, right before CPI, by a Bloomberg macro analyst, which we got something out of. So we want to share it with you, especially after yesterday's PPI. And we're also going to discuss the World Gold Council's 2025 gold outlook, which, as always, is a must-read for gold people. Let's start with the markets. We'll leave the gold chart up there. All right, 10-year yields are up almost 2 basis points at 434.7. The dollar is 106.93, down 7. The S&P 500 is 60.75, up 24. The VIX is 13.42, down 49. Gold is 26.68, down 12. Silver is 30.77, down 13. Copper is 4.19, down almost about a half cent. WTI is 70.67, off the bottom of a range, up 59, I think. Natural gas is 3.29, down 2 cents. Bitcoin is 100,390, up 298. Ethereum is 39.07, up 24. Palladium is up a couple bucks at 9.73. Platinum 9.34, up $1. Gold, silver is slightly firmer, 86. Soy is down 3 at 9.94. Corn is unchanged, offered at 4.30, and wheat is up a little less than a penny at 5.62. There's the gold chart. You can see that's the 50-day moving average that we're right on top of, and below that is the 100-day that served as support the first time down. We'll do a little chart exploration later on in the conversation. Inflation is getting entrenched. Okay, we're going to discuss that. There's that story. I repinned it. It's 2 days old, which is old, I guess, by our standards, but it'll be in Bloomberg in about 6 weeks, even though one of their better analysts wrote it. All right, moving on. Silver's time to shine. Thursday's PM Post. We'll get into that stuff later on. Let's start with the World Gold Council's gold outlook for 2025. The World Gold Council predicts a range-bound but resilient performance for gold in 2025, contingent on 4 key drivers: economic expansion, risk, opportunity cost, and momentum. Risk is a very broad term. We'll get into that later on. Quoting them, gold is poised for its best annual performance in more than a decade, up 28% through November. Behind this, central bank and investor buying have more than offset a notable deceleration in consumer demand. Asian investors have been a near constant presence, with lower yields and a weakening U.S. dollar in Q3 fueled Western investment flows. However, it is gold's role as a hedge amidst rising market volatility and geopolitical risk that most likely explains its remarkable performance. We will abstain from comment. There are several nice charts in here. Here's one. It's good to work with. It's like a blank you want to keep handy, I think. Gold responds to a combination of factors that influence its role as a consumer good and investment asset. So dark blue is very bullish. Dark red is very bearish. And then at the top, you have 3 columns: Fed funds rate giving the scenarios. And then it goes through how sensitive the market would be to these factors given the different rate scenarios. Now, if you look at that for a little bit longer, pardon me for reverse engineering this, basically they've taken these factors: opportunity cost, economic expansion, risk and uncertainty, momentum, and they've given them a correlation. What's another word for it? A percentage. And then they said Fed Fed with rates too high, Fed with rates just right, Fed with rates too cheap. And it basically, you'll see these go from, they'll change based on that color. Anyway, it's a nice little commentary there. The report concludes Quote, gold's role as a hedge remains firmly cemented, particularly in an environment of geopolitical uncertainty and financial market volatility. Potential risks such as central bank demand deceleration or prolonged monetary tightening could introduce headwinds, but the interplay of these factors underscores gold's strategic value. Prolonged monetary tightening, well, we're in an easing cycle right now, worldwide. Okay, so if they mean in the bigger picture, yeah, that's actually a big deal. So this continues at the bottom. Inflation is getting entrenched. There is a good leading indicator for U.S. inflation. Now, it's good, but it's gotten better post-COVID. It includes in its outputs commodities, money growth, and lagged inflation. As the chart below shows, we'll get to that in a second, the indicator had moved sideways and has remained above 2% for the last 18 months, either red oval there. Now, the inputs that go into this, that's the bronze or gold line there, are, I need to leave this up here for a second so I can remember, our commodities, right? So it takes commodity prices and current prices and pulls them into the calculation. It takes money growth, current money growth, and pulls into the calculation. And lag inflation, which is inflation that's in the pipeline but hasn't been felt yet, let's say like rent rises, or other things that come up in contractual fashion, union wages, and it throws them all in there and it tries to predict the next level. Now, I looked at this relatively closely, and it's not perfect, but it seems to be perfect since 2020. That meaning it will spike before inflation does. It will drop before inflation does. And now it's chopping around. I'll make it bigger for you now if I can. Yeah, not bigger. All right, well, you get the idea. It will chop. It's chopping right now. So the question is, will it chop and break or will it chop and rally? So forget the question, right? Look at it from a technician's point of view. This was the bottom then, right? And this is the bottom now. So I don't think it's usually the bottom unless there's a crisis, financial crisis. Didn't even get below this level during COVID. That's because they just funneled so much money into the market. Anyway, look, it's basic, okay? Now, the reason I'm bringing this up today, aside from, the obvious, is PPI was yesterday. Now, I mentioned PPI doesn't get as much attention as it should from the mainstream media, but in many ways, it can be more important or a leading indicator. And PPI came in very hot yesterday. Now, come in a little bit higher than normal, but let's just zoom out a little bit, okay? Just to paraphrase what Zero Hedge said. It was already supposed to come in higher, and it was expected to come in higher by 0.2%. So we're already expecting higher inflation. So inflation bottoming is what I mean. But it came in even higher than that. So what does PPI reflect? It reflects inflation in the pipeline like this. So commodity demand, raw material demand, things that manufacturers buy going into making their products. Now, if they pass the cost on, that becomes CPI. If they don't, that becomes potentially recession. So here we are. Do you think they're going to pass the cost on? Well, yeah, I think they're going to pass the cost on because it's being entrenched. That's what this article is, and it's very good. I recommend you read it. If you're looking for are we at the bottom of inflation? If you're hoping it'll go lower, it's not going to go lower. I mean, I want it to go lower, but it won't go lower in the things that you need it to go lower in. How's that? Maybe airfares will get cheaper. Anyway, there's a link to that as well. What's the final line I have in this? I have a line here. Oh, yeah. See, this is a quote from the article. CPI autocorrelates, which is one of the reasons why inflation can become entrenched as it looks to be today. So they're basically saying this bottoming will become a bottoming in CPI. It auto self-correlates. Moving on, news and analysis, gold and silver EFP leads to mini COMEX squeeze. That was yesterday's ChatGPT topic. I just gave it a more gold and silver headline. Rabo, 2 more cuts and Fed likely done. It's an interesting article. I think the consensus is now, the emerging consensus from the banks is 2 cuts, this one in January, and that's it. Founders, what can go right under Trump in 2025? That's Deutsche Bank's analysis, Jim Reed, Thursday PM Post, which is a combination of things. Market news. The first news item is the one that we care about as gold and silver people, as precious metals and commodities people. The producer price index increased 0.4 for December, higher than the Dow Jones consensus estimate of 0.2, which is what I just said. However, excluding food, however is the word but in these articles. Okay, this has got to be mainstream media. However, excluding food and energy, however is this is the truth and here's the spin. That's what however means in a mainstream media article. So, however, excluding food and energy, core PPI increased 0.2%, meeting the forecast. First-time claims for unemployment insurance totaled a seasonally adjusted 242,000 for the week ending December 7th versus the 222 forecast. So, in combination, that's very stagflationary, right? PPI is hotter than expected. Unemployment is, or claims for unemployment are higher than expected. But overall, I think the Fed's looking at the inflation thing again right now. Next, OpenAI has finally released the real-time video capabilities for ChatGPT that it demoed nearly 7 months ago. And there's a whole story on that, but I chopped it off. Comment about this, right? You could just change the channel right now if you want, but this is AI being dangerous. All right, about 7 years ago, I'm a techophile. About 7 years ago, there was a product, and that product was a combination of hardware. So basically, you would have an iPhone, right? And you would hold the iPhone, and you would have a camera attached and hanging around your neck, and the camera would see everything you saw, right? And you would have an earpiece, and you would have your phone, and the camera would look at something, and when the camera looked at something, you had glasses for to see, right? So it's kind of like the visual glasses, right? So you had the glasses on as well. So your phone's in your pocket, okay? Boom, that's your computer. Your camera's here, and you're wearing these glasses. This is before what we're about to get into. The camera would look at something. You would look at something, and the camera would process what it saw, look on the internet for it, find it, and then give you an explanation of what it was, okay? And it would also give you potential for recommendations and what have you. So you walk into a store, right, and you look at a shirt, and it will be $20, and it would give you what the shirt's made of and all these things. And the person that was recommending, that was showing this, got into the fact that it could be very hazardous because whoever's platform you subscribe to would make you forget the advertising parts of it, right? Forget that. At least you know what's coming on that. But you're going to be steered away from things because it'll say it'll basically tell you what it wants. It makes a lot of room for ideology, right? So, or ideology, depending on how you say it. Anyway, so AI is this concept in one spot. It's going to recognize something, it's going to tell you the facts about it, and then it's going to have a license to spin however, and then it's going to go through these things and just basically program you. Anyway, so far from being a Luddite, these are very dangerous tools in the wrong hands, and there are no right hands to have absolute power. All right, enough with that over. All right, so Warner Brothers is going to split. Basically, they're going to go and split into 2 companies, the one that's not making money and the one that's going to have potential growth. Apple's ambitious plan to create in-house components. It's the era of hardware. If you look at the cycles of computers, the last, say, 30 years or 20 years, let's say, were software generated, right? Software gave you all the capability. Before that, it was the hardware. So the hardware got really good, and then the software caught up, and now the software can only do so much, and now better hardware is coming out, and then we'll have potentiality from the hardware, from software in the next generation, but it's kind of like a little bit of a leapfrog thing. Beneath a stock market that goes from one record to the next lies a concerning trend for some Wall Street strategists. Fewer stocks are buttressing the advance. Bloomberg, that's 12 months later, that story came out. The European Central Bank cut interest rate. This is important, I think, if you're European. The European Central Bank cut interest rates by 1/4 point to 3% as it watered down its hawkish language and warned that growth would be weaker than it had previously forecast. They're going to have to ease if we keep easing to catch up. They're a little bit out of sync with us. Plus, they have to deal with the dollar. And the Ukraine war is not helping their economy. So if the Fed stops cutting, what do they do? Anyway, here's a surprise. Trump's economic advisors are considering doubling the state and local tax deduction, a popular but expensive tax break that could deliver big savings to many residents of New York, New Jersey, and California. All right. This is extremely interesting to me, but there's another piece to this. And maybe the other piece hasn't dropped yet, but it's probably some serious 3D chess here. These are blue states, right? Increasing deductions for these states. You know what? This would encourage people. This would disencourage people to leave those states. This keeps home values in the states higher and reduces transients out of states. And those are the states that are losing the most people due to taxes. So it could be pretty smart. All right, moving on. That's initial reaction. I have no idea, right? So today's data, import price index at 830, and there's the gold outlook charts. Couple charts there. Gold is on the 50-day. Don't expect that to hold. I'm not bearish, but the 50-day is not that important, especially if it has a flat line. If it's sloping up or sloping down, people care about it more. So it could chop around there, it could go through it. Silver, on the other hand, is back to near the 100-day, but the 100-day is sloping up. That's good. Moving to the next chart, I did a little bit of work this morning. I think I actually recorded it in error. Let's put those little lines there. All right, so gold's MACD is coming off overbought. Silver's on its way to oversold, actually quite neutral. Oh, I know what I wanted to share. We'll hide this. We don't need this right now. All right, I wrote it down. Don't be short silver if gold gets back above 26.75 and it stabilizes above it. And don't be long gold if silver gets below 30.65. So there's your day, right? If silver gets below, this line, I drew the line, right? If silver gets below this line, here, I'll give you an hourly. If silver gets below that line, you're not going to make money being long gold. I mean, you'll probably make more money being short silver. But on the flip side, if gold gets above this line, just for today, after 9:30, let's say, I wouldn't be short silver. Silver could rocket if gold gets back into this range. Anyway, I'm Vince. Happy Friday, and catch you all next week.